Right. So, very good morning.
Morning.
Welcome back to those who are with me for Group 1 sessions, and welcome to the revision sessions of Advanced Accounting. First thing, apologies for the late start. Had some last minute hassles. So, yeah, I will zoom in. Right. So, I hope the audio and video is clear for online students. Can you please confirm so we can get started? No. Okay. Yeah, I hope the audio issues should be better now. You should be able to have better audibility. Right. Okay. So we're going to get started with Accounting Standards Part 1 for today. The first standard that we are going to discuss is As4, contingencies and events occurring after the balance sheet date. Right? So friends, this standard is a basic standard. When I say it is a basic standard, it is a mandatory standard across all the enterprises. So any enterprise is supposed to follow this particular standard. Now, let's have a quick summary of what is As4 all about. Okay, let's understand the gist of the standard, and then we will go to some questions from your past asked and from your MRTPs, etc. Right? So As4, the discussion is of two parts: contingencies and events occurring after balance sheet date. But contingencies, if you see, when the standard got revised, this contingencies paragraph was mostly covered by the other standards, predominantly AS29. So it has got removed from the As4. Okay, so our As4 discussions will be limited to events occurring after balance sheet date. Now, what are events after balance sheet date? When I say events, events are any transaction which result in the change of an asset or liability, right? And when I say it occurs after balance sheet date, it is after the closure of the books of accounts. So effectively after the cutoff date that you take for closing your books of accounts. Now, when you're closing your books of accounts, we will generally have one particular cutoff date, and some transactions might happen after that cutoff date. Naturally, business is running. So now the question comes, how should I deal with those transactions? Why this question comes? Because if I say 31st March is the closure date, not on always 31st March cannot be the date on which you close your books. Practically, it will take some time for you to finalize your books of accounts. So there is a gap between closure of books and finalization. And in the between that gap, if something happens, if certain transactions happen, how should we deal with those transactions? And that is what is about events occurring after balance sheet date. So events occurring after balance sheet date are those events that occur after the date of closure of books and before the date on which the financial statements are approved by the board of directors in case of a company, or the approving authority like the proprietor, partners, or trustees, managing trustee, whoever it is, for any other entity, right? So the time width is very simple, from the date of closure of books till the date of finalization or approval of the financials by the respective authority. So in the exam, if you have a question with with the dates given, we need to check whether if the transaction is first falling within this two time periods, which is 31st March or closure of your books and the date of approving authority finalizing the report. If an event is falling after that particular date, flat, it does not fall under the purview of As4. It does not come under As4. So Only if it is going to come within this time window, then it is going to form a part of AS4. Right? Okay. Now, so once we have understood that what is part of AS4, we are going to see what is next. What is next? How does this event get categorized? So how is this event getting categorized into? It is getting categorized into two parts: adjusting events and non-adjusting events. So what are adjusting events? Adjusting events are, the word itself says, that which require adjustment, as simple as that. So basically, events that have occurred after the balance sheet date, but those events are going to be adjusted in the books of accounts. So what is the term that we need to understand? Events which provide further material evidence of a condition already existing on the balance sheet date. So, as on the balance sheet date, okay, as on 31st March or before 31st March, considering 31st March is the balance sheet date, if the authorities were aware that something could happen, and if whatever they were afraid of or whatever they were thinking has happened, then that event becomes an adjusting event. Say for example, if a customer has been running through some heavy losses, so this fact is known already to the management that this customer may have difficulty in repayment. So in that case, now what happens when the customer is facing a difficulty in repayment? The management has to be aware that this amount can be treated as bad debts or probably should be treated as bad debts. Now, after 31st March, if that customer turns insolvent, then the entire amount of bad debts will be treated as adjusting events, which means as on 31st March itself, I need to provide for the same in the books of accounts, which means the asset value or the debtors value will reduce. So the point is, as on 31st March, if you are aware of the fact that something could happen and whatever has happened later is just further evidence of what you are aware of, then it is called as an adjusting event. And what is the rule of an adjusting event? It needs to be adjusted in the books of accounts. In which year? It has to be adjusted in the same financial year and not in the subsequent financial year. Okay, even though the transaction happens subsequently, it should be adjusted in the same financial year. The opposite part of it, non-adjusting events. Again, the event has happened. Event has happened after the balance sheet date. However, as on 31st March, I was not aware or there were no conditions existing as on 31st March. There was no reason to believe that this could happen as on 31st March. Then in that case, it will be called as a non-adjusting event. So the word itself says it is non-adjusting. So what is non-adjusting? It need not be adjusted in the books of accounts. So when I say it need not be adjusted, you are only going to disclose the fact, not in the financial statements. The fact will be disclosed in the approving authorities report. Not in the financial statements. Let us be very clear. See, whenever you have a disclosure in financial statements, it should be adjusting. If it is not adjusting, it will not enter your P&L balance sheet notes to accounts. It will enter the director's report or notes given by the proprietor. So basically, any approving authorities report. Okay. So the two rules here is adjusting events, you need to adjust the same, and non-adjusting events, disclose it by way of a note in the approving authorities report if it is significant. Okay. How to identify adjusting or non-adjusting? If it is adjusting, there will be some condition existing on or before the balance sheet date. Whereas if it is non-adjusting, the event would have arisen after the balance sheet date where there were no conditions before. That is the rule. What is the treatment of adjusting and non-adjusting events? That is what we discussed. Needs to be adjusted in the books of accounts as on the balance sheet date with the corresponding asset or liability. Whereas if it is non-adjusting, it needs to be disclosed in the approving authority's report if it is material. Okay. Now, this is the crux of the standard. The standard is only about adjusting or non-adjusting events. However, there are certain exceptions or there are certain special treatments under AS4. What are the special treatments? Two scenarios only. Statutory payments. And the most common statutory payment that is going to get questioned is on dividends. Second, events which affect going concern. Now, first let us discuss about dividend. Now, dividend, if you see, is proposed by the directors after the closure of books of accounts at the time of finalization. So, it is an event after balance sheet date. But as on 31st March, ideally there is no evidence. You do not know that you are going to declare dividend or not as on 31st March. So, which means there is no evidence and therefore, it shall be treated as a non-adjusting event only because there is no evidence. Earlier, okay, Companies Act earlier had this rule saying that dividend has to be adjusted. It was treated as adjusting event. But Companies Act got amended and from 2017 onwards, practically speaking, from 17 onwards, this rule is applicable. And especially in your last 2 or 3 attempts, this question has been asked as an amendment related question. Okay, so please make a note. Dividend is treated as a non-adjusting event only. It is now no longer an adjusting event. Okay. So dividends proposed and declared after balance sheet date need not be adjusted in the books, even though it pertains to the same financial period. Why? Because no obligation exists as on the balance sheet date. However, if the law gets amended later, again subsequently, then it will become an adjusting event. So the law will always prevail over the standard. But as of now, for your examinations, remember this amendment, dividend is a non-adjusting event. And rule number 2, certain non-adjusting events, like for example, a fire which takes place in the factory, if it is going to be of a major nature, where it affects the substratum of the entire entity. Like it affects the entire entity's business, causing it to lead to a situation where the going concern might get affected, which means there is no certainty of carrying on business for the future. If going concern is getting affected, then even though it is a non-adjusting event, it will get adjusted in the books of accounts. So it will get treated as if they are adjusting events. Okay. So events affecting going concern. In case of any event occurring after balance sheet date, where the conditions did not exist prior to the balance sheet date, then evaluation of the impact of such events on going concern is to be made. If such impact is present, then the same shall be adjusted in the books. Else, it shall be treated as non-adjusting event. So only if it is affecting going concern, we need to adjust it in the books and accordingly disclose. Else, it will be treated as if it is a non-adjusting event as usual only. So this is the crux of AS4. What are the points to remember? What is an adjusting event? What is a non-adjusting event? And first thing, how to check event after balance sheet date. And what are the exceptions for non-adjusting events? Dividends or any statutory payments and events affecting going concern. Quickly run through and then we get started with the questions. Any doubts in the standard? Yes, ma'am.
If any impact is not there,
Non-adjusting event. If the impact is not there on the going concern, it will still be treated as a non-adjusting event. So if it is significant, you will only disclose it in the notes to accounts. So what is the meaning? The meaning is that it will not get adjusted in the same financial period. It will go to the next financial period for adjustment, like a normal transaction. Yes. You can ask your doubts here. Okay, someone is asking, what about frauds and thefts? Okay, frauds and thefts, we will again be discussing that question. Are they adjusting or non-adjusting? A fraud has occurred on or before 31st of March, but it has got detected later. Why? Because the condition has already existed before the balance sheet date. You have not found out the evidence. That is not what we need. Is the evidence present? Yes. If the evidence is present as on the balance sheet date, then it becomes an adjusting event. Okay? I hope this answers your question, whoever asked it online. Yes, ma'am. Okay, if it is declared during the year, then it will not come under AS4 at all. Because it is not event after balance sheet date. Only dividends proposed. See, okay, let me also tell you one small hint. In your exam, especially if the question is on AS4 dividend, they interchange these two words declared and proposed. Even in your last attempt or one attempt before, I don't remember, they had interchanged these two words. They meant proposed dividend, but they actually asked about used the word as declared dividend. But the point that you have to understand is, if a dividend is proposed or declared, whatever be it, after the end of financial year, then only it comes under this question of AS4 events after balance sheet date. If it is proposed or declared before the financial year end, then it does not come under AS4 at all, because it is events before balance sheet. AS4 does not cover it. Right? So in the exam, don't get confused between these two words, declared and proposed. Look at the date. Very simple, look at the date. And that will give you the answer to most of your questions. Right? Yes, ma'am.
Proposed dividend or declared dividend after the both report. Then it should be.
Then also is not AS4.
Should we disclose or not disclose?
Okay, a dividend which is declared after the board's report will not form part of your financials at all. It will go to the next financial year. Okay, and it will not come under purview of AS4 because it is not events before closure of boards. Yes. Shall we start with the questions? Yes, friends, shall we start? Question 1. T Limited closes its books of accounts every year on 31st March. The financial statements for the year ended 31st March 20 are to be approved by the approving authority for on 30th June 2020. During the first quarter, which is between 31st March and 30th June, following events have taken place. The accountant of the company seeks your guidance in the following. First, T Limited has an inventory of 50 stitching machines at a cost of 5,500 per machine as on 31st March. The company is expecting a heavy decline in demand in the next year. The inventories are valued at cost or net realizable value, whichever is lower. During the month of April, due to the fall in demand, the prices have gone down drastically. The company has sold 5 machines in April at a price of 4,000 per machine. So let's answer situation by situation. So point 1, please go ahead and give me your answer. So here, first question, is it an event occurring after balance sheet date? Yes. Okay. So first question. So let's go and answer it step by step. First question, is it an event occurring after balance sheet date? Yes, because the decline has happened in the month of April, which is between the period. Second question, is it adjusting or non-adjusting? So for that, how do we see? Is the condition existing on the balance sheet date, on or before the balance sheet date? Which means as on 31st March or before 31st March, do you have any hint or evidence? Even if you have a hint, take it as an evidence. Okay. So the question says the company is expecting a heavy decline in demand next year. Okay. So which indicates that the company is already anticipating that there will be a fall in the prices of inventories. So there is a condition that is existing already on the balance sheet date. Therefore, it shall be treated as adjusting event. So 2 points for us to check. One, date. Second, whether condition is existing. So condition is existing here. Therefore, treat it as adjusting event. Now, what will be the treatment? We need to adjust the inventory for the difference between the cost and the net realizable value, because we need to reduce the cost of the inventories so as to reflect the net realizable value. Now let us see how your answers have to be given. Friends, in accounting standards, I think I would have also told you when we did group 1 to friends who had done group 1 with me for revisions. Now again I'm repeating, accounting standards la first thing that is important is your answers. Second thing that is more important is the way you write your answer. If your answers are right but you don't write it correctly, you will still not be getting enough marks. So it is always important for you to understand how to present an answer before before writing it down. So picturize your answer in mind, how your answers need to be presented. So how do we present an answer for accounting standard? Let's keep certain basic rules. We always will start it as per AS. Name the standard. Within quotes, write the name of the standard. However long it may be, write the full name of the standard. Then write the provision. And write only the provision that is relevant. Do not write the entire standard. We do not want the entire standard. We are only writing for 5 marks. So write only what provision is required for that particular case. Leave space. Write your conclusion. In the given case, write your conclusion. So this is the pattern that you will always keep in mind when you are writing the standard. Now I give you 2 minutes for you to attempt writing this answer as though you will write it in the examination. Please start. And we will cross check your answers. Friends online, I hope you are also writing too. Sang.
யூஸ்வலா அக்ரிமெண்ட் அந்த மாதிரி திங்ஸ் தான் உங்களுக்கு ஃபார்ம் எவிடன்ஸ்னு இருக்கும். நீங்க எக்ஸ்பெக்ட் பண்றது ஆன்டிசிபேட் பண்றது கூட
The question is not about evidence in AS4. The question is about a condition. Even a hint is a condition.
No, but you can expect to be however you want.
No, when you expect, you have some basis for which based on which you expect. You can't randomly go pessimistic approach, right?
So that means they're expecting based on the facts.
Yes, yes, yes.
காஸ்ட் தனியாக மென்ஷன் பண்ணலாம் 1500 அப்புறம் 500 realizable value as useless.
Shall we go to the answer? Events occurring after balance sheet date are those events, both favorable and unfavorable, that occur between the balance sheet date and the date on which the statements are approved by the board of directors in case of a company and by the corresponding approving authority in case of other entity. Point number 1. Point number 2. Assets and liabilities should be adjusted for events occurring after balance sheet date that provide additional evidence to assist the estimation of amounts relating to conditions existing at the balance sheet date, or that indicate fundamental accounting assumption of going concern is not appropriate. Okay, ma'am, should I write this statement as it is? This is what your suggested answer gives. Okay, let me be very clear. But we may not be able to reciprocate this 100% as it is. No problem. Catch the keywords. That is very important. So here what we are going to write, assets and liabilities should be adjusted for events occurring after balance sheet date if they provide additional evidence of conditions existing on the balance sheet date. This is your keyword. If this is present, your answer is valid. Right? So on the basis, let's see the answer for question number 1 or subdivision 1. Since as on 31st March 2020, T Limited was expecting a heavy decline in the demand of stitching machine. Therefore, decline in the value in April 2020 will be considered as an adjusting event. Hence, T Limited needs to adjust the amount in the financial statements with respect to the net realizable value of the inventory. Accordingly, the value of the inventory will be written down at 4,000 rupees into 50 units. So, which is value of the closing stock will be rupees 2 lakhs. You can also go ahead, you would have also written the point, the difference between 5,500 and 4,000, which is 1,500 into 50 units, which amounts to 1,500 into 50 units. 75,000 shall be written off in the books of accounts. Okay. So both we can write for our clarity purposes. So let's write rupees 75,000 shall be written off from the books of accounts. 1,500 into
4 machines.
that is irrelevant. No, we are doing it as on 31st March. Okay. So for people who have this doubt, the company has sold 5 machines. Is that 5 machines relevant? No. We are doing the adjustment as on 31st March, on which date how many machines we had? We had 50 machines. So we are not bothered about the machines that happened in April. We are only bothered about the valuation. Right? So remember, the sales in April is not what we are going to be concerned. We are only valuing the machinery as on 31st of March. Okay, so this is question number or subdivision 1. Is that clear? Subdivision 1? Any doubts? Okay. Subdivision 2. A fire has broken out in the company's godown on 15th April 2020. Okay, before that, Jawahar asked, prices declining in April. Doesn't matter if the prices are actually declining in April. The condition is already existing as on the balance sheet date, which means the company is expecting a heavy decline in the demand. There is already a pre-existing condition. Therefore, it will be treated as an adjusting event only. Right? Yes.
What if like Nestle company closes books on
Yeah.
and events occur on 31st March?
Okay.
So will it be adjusted?
Depending on whether it affects the going concern or not. Say for example, you are operating a company As on 31st December, you are closing the books. January, the government passes an order saying that these type of goods should be banned in India. Closed. Similar to what happened in many of your manufacturing, in many of your food product industries, right? So in that case, on 31st of March, did you have an evidence? No, I did not have an evidence. So ideally, it is a non-adjusting event. However, if the event affects the going concern of the business, then it shall be treated as if it is an adjusting event. Right? Coming back, question number 2. A fire has broken out in the company's godown on 15th April 2020. The company has estimated a loss of 25 lakhs, of which 75% is recoverable from the insurance company. First question, is it an event after balance sheet date? Yes. Is it an adjusting event? No, because we did not have the evidence of fire as on 31st of March. So now the third question, when it is a non-adjusting event, go ahead and ask the third question. What is the third question? Is it affecting the going concern? Now in this case, the loss is 25 lakhs, which may not be material. Also, 75% is recoverable. So your loss is only 25%, which is still immaterial. Therefore, we will assume that it does not affect the going concern. Therefore, it shall be treated as non-adjusting event and shall be disclosed in the board's report or financial authorities report. Approving authorities report. Right? Let's check the answer. A fire took place after the balance sheet date, that is during 2021 financial year. Hence, the financial statement should not be adjusted for the loss incurred to the date of fire. Okay. However, in this circumstance, the going concern assumption is evaluated. In case the going concern is considered to be appropriate even after occurrence of fire, or we can write assuming that the going concern is appropriate in case of fire, no disclosure is required in the financial statements. But the most important point we will write, however, if the loss is significant, then the same shall be disclosed in the approving authorities report. Or board report. Okay? Right? So if this is a continuing question, so we are answering only the given case. But if it is going to be a separate question, you will start in case of events occurring after balance sheet date. If no evidence or condition exists as on balance sheet date, it shall be treated as a non-adjusting event. However, if the event affects the going concern of the entity, then the same shall be adjusted in the books of accounts. Is that clear? Take down the hints wherever relevant. And then we go to question number 3. Subdivision 2. Yeah. Moving on to point number 3. A suit against the company's advertisement was filed by a party on 10th April 2020, 10 days after the year end, claiming damages of 20 lakhs. Is it a contingency or event occurring after balance sheet date? It is a contingency. So, we will write the contingency is restricted to conditions existing on the balance sheet date, which means we will only be covering the contingencies till 31st of March or till the closure of financial year. However, in the given case, the suit was filed by the company against the company's advertisement by a party on 10th April for an amount of 20 lakhs. Therefore, it does not fit into the definition of a contingency and taken as non-adjusting event. So, we need not disclose this in the financial statements. Right? Please take down the hints. This was your May 2022 RTP question.
Contingency does not come under this AS4.
Contingency is restricted in AS4. They have said what is a contingency, but more details about contingency has been given under AS29. So a contingency, to the extent it is adjusting or non-adjusting, will alone appear under AS4. We cannot write that because AS4 partially covers. The standard's name is contingencies and events occurring. So we will say, yes, therefore it is a non-adjusting event. So you have to convert your answer like that. Okay? You cannot say that it is not under the purview of AS4. It is still under the purview of AS4, but it is restricted purview. Right?
31st March contingency.
It will form part of balance sheet notes.
So it will be treated like an adjusting.
No. In that case, go to AS29. After the balance sheet date, it is not going to be forming part of the contingencies as on balance sheet date. Therefore, it is treated as a non-adjusting event. That's all. Okay. So, if a question, I repeat, please listen here. If a question is asked on contingency, and if the question is silent, then we will answer it with respect to AS29. But sometimes the question will ask a contingency and they will specifically say answer with respect to AS4. Then in that case, you should see whether that contingency is as on 31st March or after 31st of March. If it is as on 31st March, okay, then you will write that the contingency shall be disclosed in the notes to accounts according to AS29. One line over. According to other prevailing standards. So here the other prevailing standard is AS29. But if the contingency is going to be after the balance sheet date, then directly you can say that it does not form part of contingencies as on 31st of March and hence treated as a non-adjusting event. Okay. So if the question comes from AS4, then answer it this way. If they are not mentioning anything, you can directly go ahead and write from AS29. Still valid, right? See, in AS, the answer will look flat. You don't have to think too much for the answer. The answer will be very simple. நம்மளா அதிகமா யோசிச்சு answer complicate பண்ண வேண்டாம். The answer is going to be very simple, but what is important is how you present your answer. Okay, so please make enough notes for your while writing your answers. Someone was asking a question. Can you please repeat the question? Okay, if the management expects that some litigation might arise, even then it will be treated as a contingency subject to the coverage given under AS29. So we will discuss that point, Sanjay, when we discuss AS29 in detail. Okay. So shall we go to question number 2? Is question number 1 clear, friends? Right? Right. Question number 2. As per the provisions of AS4, you are required to state with reason whether the following transactions are adjusting or non-adjusting events for the year ended 31/3/21 in the books of New Limited. One of your past asked questions. First, equity dividend was declared for 2021 on 15/5 at 7%. So it is a non-adjusting event. But what is the answer that we are going to write here? Dividend for dividends declared, the condition did not exist as on balance sheet date. Therefore, it shall be treated as a non-adjusting event, comma, unless the law provides otherwise. Okay, that word will say that this is a statutory provision. The law has changed the provision, so we are going by the provision. So, unless the law provides otherwise, that word has to be present. Next, on 5th March, 53,000 was collected from a customer but not deposited by the cashier. This fraud was detected on 22nd June. So a fraud has happened which has got, it is an adjusting event. The evidence or condition exists as on the balance sheet date even if it is unidentified. The fact that it was not identified is not relevant. Whether there was an evidence on the balance sheet date. If yes, it is an adjusting event. Point number 3. One building got damaged due to fire on 23rd of May. The loss was estimated to be 81 lakhs. Okay. The loss was anticipated to be 81 lakhs. We do not know whether this 81 lakhs is material or not. So we give our answer saying that this is a non-adjusting event because condition did not exist on the balance sheet date. However, assuming that the going concern is still valid, it will be treated as a non-adjusting event. Or if the going concern has been affected, then the same shall be adjusted in the books of the accounts. So you need to give both the answers because we are not sure whether it affects the going concern or not. Okay? Right? Never leave the examiner to see for options in your answer. You give him all the options. Right? It is an adjusting event because the evidence exists on the balance sheet. Yes. Second question is an adjusting event. Let's look at the answers. Question number 2. First adjustment. I'm telling you how your answer has to be written. Okay. If the dividends are declared after the balance sheet date, but before financial statements are approved, then the dividends are not recognized as a liability because no obligation exists unless statute requires otherwise or the law requires otherwise. Such dividends are disclosed in the notes. Thus, no liability for dividend needs to be recognized in the financial statements for the financial year ended 31st March. Declaration of dividend is a non-adjusting event. The order of writing these sentences is fine, okay, but ensure your keywords are present and you give it in the format that we have structured as per the standard, then in the given case. Right? Adjustment number 2. As per AS4, an event occurring after balance sheet date may require adjustment to the reported value of assets and liabilities if such events relate to conditions existing on balance sheet date. In the given case, fraud of the accounting period is detected after balance sheet date but before approval of the financial statements. It is necessary to recognize the loss. Okay, I think that statement is missed. As the condition existed on the balance sheet date. There was a fact of fraud happening on that particular date, right? Before in the month of March itself, the fraud has happened. So you have evidence in the books that in the month of March itself, this particular issue has happened, right? So it is necessary to recognize the loss as the condition existed on the balance sheet date. Thus, the loss amounting to 53,000 should be adjusted in the accounts for the year ended 31st March. It is an adjusting event.
So detection does not matter.
Detection of fraud is not relevant here. Third question. So this is where we are going to write both the answers. AS4 states that adjustment to assets and liabilities are not appropriate for events occurring after balance sheet date if they do not relate to conditions existing on balance sheet date. You can reword it. Okay. The damage of the building did not exist as on the balance sheet date, that is as on 31st March. Therefore, it shall not be recognized in the financial year as it is a non-adjusting event. As it is a non-adjusting event. However, according to the standard, any unusual changes affecting the substratum of the enterprise after balance sheet may indicate a need to consider the use of going concern in the financial statements. Okay. As per the information given in the question, the fire has caused major destruction. Therefore, the question of going concern is evaluated. Considering the going concern approach is still valid, the fact of fire together with the estimated loss of 81 lakhs should be disclosed in the approving authority's report for the financial year 2021. So first part we are writing it is a non-adjusting event. However, if it affects the going concern, the same shall be disclosed in the approving authority's report. Is that clear? Right? Any doubts in the questions that we have discussed in AS4? So predominantly AS4 questions are theory oriented questions where they are going to ask you very simple whether it is an event after balance sheet date or a contingency, and if it is event after balance sheet date, if it is adjusting or non-adjusting. So we have seen close to 6 scenarios here, 3 in the first question, 3 in the second question. I hope the scenarios are clear. Any doubts? Okay. So this summarizes our first standard, again one very repeated standard, AS4. Shall we move on to the next standard? AS5, net profit or loss for the period, prior period items and changes in accounting policies. Again, this is a basic standard. This standard is again mandatory to all the enterprises. Okay. Now, what is the purpose of this standard? This standard is not going to say what should be included, what should not be included. This is a disclosure related standard. Okay, this is only relating to disclosure and classification. So the objective of AS5 is to prescribe the disclosure and classification policies for certain items in P&L account and to describe the accounting treatment for changes in accounting estimates and policies. Now, in this standard, we have to remember 6 terminologies totally. Ordinary items, exceptional items, extraordinary items, prior period items, accounting estimate, changes in accounting estimate, changes in accounting policy. So totally 6 terms. If we are remembering what are these 6 terms, the standard is done. Okay. So let us start understanding the terms one by one. First, ordinary items. Items that are relating to profit and loss that arise as a part of business or activities relating to business. So in the ordinary course of business. So what is this? The normal items that you have in the ordinary course of business, which are disclosed as income and expenses in your profit and loss statement. So what does the standard says? If the item is an item that arises in the ordinary course of business, then just disclose it on the face of profit and loss statement as an item. If it is going to be, say, employee expenses, show it as employee expenses in the profit and loss statement. If it is revenue from operations, show it as revenue from operations. So the standard is very simple, going to put as, if it is an ordinary item, disclose the ordinary item on the financial statements. Second, one step high, exceptional items. They are items of ordinary nature only, which means they are in the ordinary course of business or usual course of business. However, their frequency or volume, which means the size, is of such a manner that they need a separate disclosure. Items of ordinary nature, but of such size and frequency or incidence that the impact is to be shown separately. Example, a large sale of a machinery, plant and machinery, instead of small spare part or scrap sales, if you are selling one whole part of your unit, okay, it is still ordinary in nature because it is in the normal course of business, but the impact is such a manner that it is huge and it is a one-time transaction, right? So such items are exceptional items. What is the rule for exceptional items? They are disclosed separately in the P&L statement with respect to the nature and amount, which means after showing them in your profit and loss account, you will also write a separate note saying what has happened and with the amount of impact. So basically they have to be disclosed in the notes to accounts also. So what differentiates an ordinary and exceptional item? Ordinary, regularly in the course of business, recurring transactions or frequent transactions. Exceptional, what is ordinary in the course of business but non-frequent in nature or unusually large in nature, one-time transactions. Okay. Third, next step, extraordinary items. Items which are arising out of events or transactions that are distinct from the ordinary activities of the enterprise, which means they are not forming part of your ordinary course of business. They are away from your ordinary course of business. Ma'am, in an exam, how to find out whether ordinary course of business or not? Very simple. If that particular activity can be controlled by you, if it has been caused by you, okay, sale of an asset, initiating a lawsuit, if you have filed a lawsuit, then it is your control. Whereas if someone else has filed a lawsuit against you, or if there are natural damages like fire, earthquakes, etc., these are reasons that are beyond your control, so they all fall under this category of extraordinary items. So simple rule for us to remember, if the item is under the business control, then if it is recurring, ordinary. If it is non-recurring, exceptional. Whereas if it is beyond the business control, then it directly goes to the category of extraordinary items. So this line you can remember for finding out in your examinations. Such items are disclosed separately in the P&L statement with respect to their nature and impact. So we need to show separately in the books of accounts. Right? So 3 items we have covered: ordinary, exceptional, extraordinary. Any doubts in these 3 categories? Run through once. We'll go to the next part.
Suppose you file a lawsuit, that's under your business, it happens. So can we say that it's exceptional?
Yeah.
Can we say that?
Depending on what type of lawsuit you file.
Yeah.
If it is a claim for like copyright or affecting your entire going concern, it could even be extraordinary. But if it is like a small claim, like you for against a fraud, if you are filing a lawsuit, or against some claim that you are filing a lawsuit, all that becomes exception. Right? Next, prior period item, which is your terminology number 4. What is a prior period item? The word itself says prior period. So period before. Expenses and incomes arising in the current period as a result of errors or omissions made in one or more of the previous financial periods. Errors or omissions made in one or more of the previous financial period. Therefore, it should be disclosed in such a manner that the impact is perceived by the user. So what does it mean? I need to show difference between what is the income or expense for the current year and what is the income or expense from the prior period item. I need to show the amount separately so that the user can understand. So it should be disclosed. Either you can write it as a note to account or you can show as two separate line items in the financials. The choice depends. But eventually you need to disclose them separately. That is what AS5 speaks about. To be disclosed in a manner such manner that the impact on the current year's profit or loss is perceived. So for example, if last year inventory has to be valued at FIFO, while doing the FIFO valuation, some costs were taken wrongly. Current year, when the auditor has done the valuation, they have found out that the last year valuation is wrong, because of which your opening stock has also gone wrong. So the difference between whatever has gone wrong and what is the correction. So the difference is the expense or income, which will be treated as a prior period item. Okay, as a result of error or omission in the past. Right? Can fraud be treated as an error or omission in the past? Can a fraud, okay, a fraud was a theft or a fraud had incurred in the last year, which was not noticed, which was not detected. In the current year, while closing the books of accounts, this fraud was detected. It is an intentional mistake which does not come under the category of error or omission. Okay. So, if a fraud or if a question comes stating it is a fraud or a theft, you can say here it does not amount to a prior period item as the intention is to defraud, and therefore it is not an error or omission. However, it shall be treated as per AS4. Go and relate it to AS4, your answer is simplified. Okay? Right? So this is item number 4, prior period item. Next, changes in accounting estimates. An estimate is made with respect to any expense or income where the basis of arriving at the actual value is not available. So wherever we use an estimate, it means that we do not have an actual valuation. The estimate changes will either affect current period or future periods, which means if an estimate is changed, the estimate will be changed for the current financial year or it can be for the future financial years. Like for example, if I am going to change the provision for bad and doubtful debts, then the impact is on current period. Whereas if I am going to change the estimate of useful life of depreciation, instead of 4 years, now I am estimating it at 5 years. Then the impact is not only on the current period, it is also on the future periods. So an estimate can impact current period or future periods. The accounting estimate shall be revised in the books based on changes in circumstances due to experience, additional information available or subsequent developments. Which means if there is additional evidence available or if the management feels that it is correct to change the estimate, it can do so. Now, if I change the estimate, then what should I do? The rule is very simple. You need to disclose it separately in the notes to accounts in the financial statements. Right? Okay. So, you should disclose the what is the change in estimate and what is the impact because of the change in estimate. If the impact is on the current year or current year and future years, whatever be the case, we need to disclose it. The standard is very simple. It is only a disclosure related standard. Right? Now, if an estimate is changed, say for example, until last year I was using a bad debts provision of 5%. Now I am going to reduce the provision for bad debts as 4%. Does this amount to a prior period item? No. A change in estimate is not an error or omission. Therefore, it does not amount to a prior period item. Second, does it amount to an extraordinary item? No, because it is still in the ordinary course of business. Okay, so they can even ask you, giving a scenario, whether this is a prior period item or extraordinary item. So you should indicate your answer accordingly. Is that clear? Next, changes in accounting policy. What is accounting policy as per AS1? Accounting policies are specific accounting principles and methods of applying those principles in the preparation of financial statements. So when an accounting policy can be changed? Simple rule. 3 rules. Only when if it is required by the law or statute. If it is in compliance with accounting standards. Third, if it results in a better presentation of financial statements or improved presentation of financial statements. So only 3 rules. Accounting policy cannot be changed otherwise. So if they ask, can you change an accounting policy? Unless these 3 rules are applicable, any of these 3 rules is applicable, you cannot change an accounting policy. Now, what happens in case of change in accounting policy? It will impact your entities' numbers or financial statements, values in the past, present and future. It has an impact on the past values, present values and future values, and therefore the amount of change needs to be disclosed along with the impact. Such change needs to be disclosed along with the impact. AS5 does not say what I should do in case of a policy change. In other words, what should be the approach adopted? Should I treat it to general reserve, profit and loss account? Nothing. That every separate standard will deal. This standard only says if you change accounting policy, disclose it. Right? Suppose I bring in a new accounting policy for the period. Which means if there is a new policy that is brought in, say like I do not have a regular scheme of employee benefits. Now I want to bring about a regular scheme of retirement benefits. So I am introducing a new policy of a retirement scheme. Earlier I did not have voluntary retirement scheme in my organization. Now I am bringing a voluntary retirement scheme in the organization. So a new policy is brought about. Does it amount to a change in accounting policy?
No.
A change in accounting policy is a change in the existing policy which does not materially alter the policy. Okay? For instance, earlier I had a retirement scheme only for employees who are voluntary retirement scheme only for employees who are serving the last year. Now I have completely revamped the scheme saying that no, I have a staged, if you are in the last 10 years service, this is the policy applicable. If you are in the last 5 years, this policy. If you are in the last 3 years, this policy. So I have changed the policy completely. Now does that amount to a change in accounting policy? I have changed the policy broadly. A small policy of a retirement scheme for 1 year has now been changed for 10 years, 5 years, 3 years, 2 years. I have completely changed the policy. So now does this amount to a change in accounting policy? No, because the change in accounting policy should be minor. You cannot change the policy in its principle fully and call it as a change. It is like a new policy. So remember, an introduction of a new policy or, this is the most important bit, or material alterations of an existing policy to change the nature of the policy. the nature of the policy itself is undergoing a change. Okay, material alterations to change the nature of the policy shall not amount to a change in accounting policy. Right? So any of these two scenarios, it will not be amounting to a change in accounting policy. So AS5, we are only going to speak about 6 terminologies: ordinary items, extraordinary items, exceptional items. This is one category. Prior period items. And the next part is changes in accounting estimate, changes in accounting policy. Quickly run through. Any doubts you can ask?
இந்த சைடுல வந்து காலியா வருது.
Done? Shall we go on to the questions? First question from your May 2022 RTP. The accountant of Mobile Limited has sought your opinion with relevant reasons whether the following transactions will be treated as change in accounting policy or not for the year ended 31st March 2021. Please advise them in the following situations in accordance with the provisions of the relevant standard. Number 1, provision for doubtful debts was created till 2%. From the financial year 2021, the rate of provision has been changed to 3%. So what is this? This is a change in accounting estimate. Right? So let's answer the points first, then we go to the suggested answers and we will see how the answers are presented. During the year 31st March, management has introduced a formal gratuity scheme in place of an ad hoc ex gratia payments to employees. So this is a formal introduction of a policy which is almost treated like a new policy, and therefore it does not amount to changes in accounting policy. Ad hoc means temporary. Third, till the previous year, the furniture was depreciated on straight line basis over a period of 5 years. From the current year, useful life is changed to 3 years. It is a change in accounting estimate. It is not a change in policy, it is only a change in estimate. Clear with the 3 answers so far?
Should I write the impact plus the past?
Yes. We will come to the answers presentation. Please wait. Management decides to pay pension to those employees who have retired after completing 5 years of service in the organization. Such employees will get pension of 20,000 per month. Earlier, there was no such scheme of pension in the organization. So, introduction of a policy for the first time does not amount to a change in accounting policy. Fifth, during the year ended 31st March, there was a change in the cost formula in measuring the inventories. There was a change in the cost formula, which means probably they might have converted from FIFO to weighted average or vice versa. It is a change in accounting policy. Okay. Therefore, the impact in the current period and the future period shall be disclosed. So, item number 1, 2, 3 and 4 are not changes in accounting policies, whereas item number 5 is change in policy. Yes,
There is a perfect continuity
Estimate.
Estimate and policy.
Okay. If there is a conflict between a change in a policy and estimate, say for example, to answer the question, let's take an example where the useful life of machinery is changed to 3 years and the method of charging depreciation is changed from straight line to WDV. So, straight line to WDV is a policy change. Useful life of 5 to 3 years is an estimate change. Now, if you cannot bifurcate to what extent policy is changing, to what extent estimate is changing, in that case, the entire change will be treated as a change in accounting estimate. Okay, so please write down. Okay, you can make a note of that point. If there is a change in policy and estimate parallelly together, and the change cannot be separately identified, then the entire change is treated as if it is a change in accounting estimate. Is that clear, friends? Going to the answers. In the first case, in the given case, Mobile Limited has created a provision for 2% for provision for doubtful debts till 31st March. Subsequently, in 2021, the company has revised the estimates based on changed circumstances and wants to create a provision of 3%. Thus, the change of rate and provision is a change in accounting estimate and not a change in accounting policy. The change will affect the current year only because it is a provision for doubtful debts. It impacts only the current financial year. Next, question number 2. As per AS5, adoption of an accounting policy for events or transactions that differ in substance from previously occurring events or transactions, which means the nature of the policy itself is undergoing a change, will not be considered as a change in accounting policy. Introduction of a formal retirement scheme by an employer in place of an ad hoc ex gratia payment to the employees is substantially different from the previous policy and will not be treated as a change in accounting policy. Next, third one is change in useful life of the machinery. Change in useful life of furniture from 5 to 3 years is a change in accounting estimate and not a change in accounting policy. So this we can continue and write, which will impact the current financial year and future years. Why future years? Because this is depreciation. So it will impact the future depreciations also. Next. Adoption of a new policy for events or transactions which did not occur previously should not be treated as a change in accounting policy. Hence, the new pension scheme is not treated as change in accounting policy. Answer for the fourth one. Last, change in cost formula is a change in accounting policy. So in this question, they have only asked whether it is a change in accounting policy or not. But if they ask what should be the treatment, then you should write one more point which says that the change shall be disclosed in the financial statements along with its nature and impact. Okay. So see the question. What is asked in the question? Accordingly, extend your answer or cut short your answer. Okay. Question number 3, is it clear? Question number 4. A major theft of stores valued at 10 lakhs in the preceding year was detected in the current financial year. How will you deal with the information? Yes. If suppose the question says, how will you deal with the information according to AS5? Examiner, they are asking, treat it with AS5. Okay. As it is intentional, it is a theft detection, so it does not come under error or omission, therefore not treated as a prior period item. But what will you do under AS5? There are three other categories, no? Ordinary, extraordinary, exceptional. It has to fall under one of these three. It is an exceptional item which will be disclosed separately in the financial statements. Okay, that adds value to your answer. The first point is something every one of us will answer. The second point gives the impact to your answer. It is an exceptional item, will be disclosed as per AS5 separately in the financial statements. Okay, but if the question does not say which standard you are answering, sometimes the question will be silent. Treat with respect to relevant AS. There you can write both AS5, AS4. So, provided the dates are clearly given. AS4 dates are important. If dates are not given, then we cannot do anything. We can only write about AS5. Okay, but remember, if you are answering with respect to AS5, if you are not saying it is a prior period item or exchange in policy, whatever it is, you should still say in which category it will fall. Mukkavasi, the items will fall under three categories: ordinary, extraordinary, exception. It has to fall under one of these three categories. Accordingly, classify and write your answer. Okay. Due to a major theft in stores detected in 2021, there was an overstatement of inventories. This has resulted in the overstatement of profit in the previous year. However, the adjustments are not required to be made as prior period items. We will add the answer here. The adjustments shall be shown as exceptional items and disclosed separately in the financial statements. Okay, don't stop your answer only with prior period item. Continue an answer saying it will also fall under the category of exceptional items. Friends, for this one question, your answer is divided. In your material, they have also given the approach saying that because it is an error in the past, it is treated as a prior period item. But primarily, I will not agree with that approach because a fraud is not an error. A theft or a fraud is not an error because there is an intention there. There is a malefic intention there, and it is not going to be treated as an omission or an error of the past. Okay. So this is your answer to question number 4. Again, this was one of your past asked questions, I believe. Okay, so the questions are can be related either to prior period items, accounting policy, new policy or existing policy change, or it can be exceptional, extraordinary items related question. So this summarizes AS5. Any doubts so far in AS4 and 5? Simple basic standards, theory oriented standards these are. So which means your questions are more, you have to write more when you write the AS, and you have to write clearly as if you are writing a theory question. Okay, do not skip on the format, do not cut short on the format in any manner. Is that clear? Okay,